we visually show you on the left-hand side the capital stack. So clearly, senior or first lien debt is lower risk because you get repaid first, while second lien mezz is considered junior risk, with equity being the highest risk of loss. When you all are analyzing direct lenders that you're looking at investing in them, you should understand what their mix is. For example, our interval fund, CCLFX, we do 95% first lien investing, as we don't want to load up on unnecessary junior capital risk. It's rare for us to do that. The chart on the right gives you an idea of the return profile that direct lending portfolios will execute on through different times and different cycles. Now, Cliffwater, we built an index called the Cliffwater Direct Lending Index many, many years ago. And it basically tracks the performance of the direct lending universe. And we do this by tracking business development companies, or BDCs, back to the early 2000s. We chose BDCs because they report regular 10Qs and 10Ks with the SEC each quarter. And so it forces them to produce consistent data, making it a great index candidate. So just so you understand what this index computes, it's roughly 80% first lien with about 20% junior risk in it. It tracks about 250 billion of AUM in the direct lending universe. And it's on an unlevered basis, gross of fees. What you can see in this dark blue line in the chart here on the right is that direct lending portfolios clearly earn something called an illiquidity premium, which is several points higher than what you can earn in the liquid markets or the high yield bond markets. So direct lenders are being compensated for the fact that you can't trade in and out of these loans, right? They're holding them to maturity. Now, clearly the premium ebbs and flows based on market conditions, but you can see it typically maintains that meaningful premium consistently through time. You will notice spikes in the yield during market dislocations, such as the Great Financial Crisis or COVID. That is because these indices take into account discounts in the secondary market. So as assets trade off or as values are marked down, that increases the secondary yield. Moving to slide 7, we can dig into the performance of our index a little bit more so you can get a flavor for the performance of direct lending. So we track direct lending performance by breaking the total return of the index into 3 main components. The first is interest income. Borrowers pay cash interest expense to the direct lenders every year, every quarter, computed as the base rate, such as SOFR, plus a spread. And so interest income can be somewhere in the 6 to 10% area in cash income coming in, okay? Today, given where SOFR rates are, the interest income is even higher. It's in the 10 to 13%. Next, we break out unrealized gains losses and realized gains losses. So unrealized gains losses is your mark-to-market change that occurs each quarter in the financial statements of every single loan. So direct lenders get their loans valued each quarter by an objective third-party valuation firm, such as Lincoln Financial or Houlihan Lokey. Those changes are called unrealized gains losses. They aren't actual losses. Marks in direct lending take into account both the financial health of the borrower and also changes in spreads in the new issue market. Then you have realized losses, which are actual losses running through the direct lender's financials. So maybe a lender sells a loan at a loss, or a loan defaults and the recovery rate was less than par. If you add up all 3 of these components, you get your total return. We've tracked direct lending total return back to 2004, so several decades of data. And as you can see, based on the trailing 1 year, the 5-year, the 10-year, and inception data, the returns are consistent and relatively attractive in that 8 to 11% area, okay? And then realized losses, of course, vary based on economic cycles and manager track record, but on average, they're around 1% a year. But if you can pick the higher quality managers, which is something we try to do within CCLFX, you can get, you produce much lower realized losses. So higher quality managers only have losses in the 10 to 25 basis point area. It's much lower. I outlined for you on the bottom of the slide why direct lending tends to outperform liquid markets and what are the factors that is setting it apart from the high yield bond and the BSL loan market. First, we talked about the illiquidity premium of 100 to 200 basis points, given that these loans are buy and hold, you can't trade out of them. But direct lending loans also tend to have lower leverage levels and tighter covenants, which results in less losses. They have smaller bank groups. This is a huge plus because it means that it's easier to handle amendments, you can move faster, and you're getting better communication with the sponsors and the management teams. Smaller deals are also easier to refinance and sell, which means that they repay faster and you have more exit opportunities than you would in the large corporate market, right? If you have investments in a $3 or $4 billion deal, sponsors may only be able to IPO that deal. It's much easier to place or sell or get out of a $300 million transaction in the middle market. Direct lenders also skew more towards defensive sectors that are higher margin. They have to want to own this risk through any cycle. So they are much more thoughtful at the outset when they're underwriting a credit. You also get more regular reporting, monthly and quarterly financials and budgets, frequent management calls, and this much deeper reporting requirements than what you would get in the liquid markets. And lastly, and most importantly, managers in this space have skin in the game. So if their track record is not favorable, if they continue to invest in bad loans and have bad performance, they will cease to exist because they won't be able to raise money. And so over time, you tend to find that the space is becoming more and more high quality. There is more accountability versus what's going on in the broadly syndicated market where investment banks are just underwriting deals and they're not holding any of the paper. So these are all the factors that I like to highlight as to why this asset class has become so attractive in the last 5 to 10 years.